Imagine you have been diligently saving into a special jar for years. The rules were simple. Put money in, let it grow, and when you're ready to retire, that money is yours. But suddenly, the person in charge of the jar changes the rules. They tell you, if your jar gets too full, we are taking a much bigger cut. Or if you don't withdraw it fast enough, we are changing the math. This isn't just a story. This is the reality of Australian superannuation in 2026. From new taxes on high balances to changes in how your earnings are calculated, the goalposts have officially moved. Just before the recent holiday break, the Treasury released a massive update on controversial super tax, formerly known as Division 296. This is the tax targeting balances over $3 million. Now, there is some good news. They have addressed one of the biggest complaints. They are no longer planning to tax paper profits, meaning money you haven't actually made yet on assets you haven't sold. But as with most things in tax law, there is a sting in the tail. Actually, there are two. If you have a large super balance or if you are on a trajectory to reach one, you need to pay attention to this. The government has introduced a new higher off test to prevent people from dodging the tax and a brand new tier for those with over $10 million. I'm Vineet, and today we are breaking down the revised Division 296 legislation. Let's dive in. Before we go any further, a quick but important note. The information in this video is general in nature. It has been prepared without taking into account your personal objectives, financial situation, or your needs. Tax laws are complex and subject to change. You should seek professional advice from a qualified financial advisor or tax accountant before making any decisions regarding your superannuation. So let's break this tax down as simply as possible. Imagine your superannuation is a bucket. Normally, the earnings inside that bucket are taxed at a flat rate of 15%. Under the new rules, starting July 1st, 2026, if your bucket gets too full, specifically over 3 million, the government wants a larger slice of earnings. Here is how the math stacks up. The base layer, you will still pay your normal 15% tax on everything. And then there is a new layer. On the earnings attributed to the portion of your balance over 3 million, you pay an extra 15% tax. That is a 30% total tax rate. And then the third one is a mega layer. This is a new addition, and if your balance exceeds 10 million, there is an additional surcharge of 10% on those earnings. That brings the total tax rate to 40% for that top tier. Now, let's talk about the improvement in the original proposal. If your property or shares went up in value, even if you don't sell them, the government wanted to tax that unrealized gain. Most experts call the move unprecedented and frankly quite dangerous for cash flow. The fix? The new draft shifts back towards normal tax principles. They will only tax on actual earnings, things like rent, interest, and realized capital gains when you actually sell an asset. It sounds fair on the surface, right? But this is where the sting comes in. It all comes down to how they decide to count your money. To calculate your tax bill, the government has to determine what percentage of your money is sitting above that 3 million or 10 million limit. The new rule states we will look at your balance at the start of the financial year and at the end of the financial year. And for the purpose of the ratio, we will pick the higher number. Why would they do this? Simply put, to stop people from gaming the system. Let's look at an example. Meet James. James has $12 million in super on July 1st. He knows this new tax is coming, so he thinks I will be clever. I will withdraw 11 million on June 29th, just before year ends. If he does that, his balance at the end of the year is only $1 million. In the original proposal, James might have avoided the tax because he finished the year under the limit. But under the new rule, the tax office looks at the start, that is $12 million, and at the end, that is $1 million. They picked the higher of the two, which is 12 million. They based this percentage on that 12 million figure. His last minute withdrawal does nothing to lower his tax rate for that specific year. However, there is one time escape hatch. For the very first year of this tax, the 26-27 financial year, there is a special transition rule. They will look at your balance on June 30, 2027. This means if you're like John and you want to move your money out of the super system to avoid this tax permanently, you have a hard deadline. You must get your balance down by June 30, 2027. If you wait until 2028, the higher of trap snaps shut and you are caught in the net. If you run a self-managed super fund, SMSF, this is perhaps the most critical part of the update. Let's say your fund owns a commercial property or residential property. You bought it years ago for a low price and it grows significantly. When you eventually sell it, you trigger a capital gain because we are back to normal tax principles. That gain is considered income and will be hit by this new tax if you are over the limit. However, the government is offering a shield for assets you already own. If your fund holds an asset before 30th June 2026, you can protect the growth that happened before that date. How it works, you bought a property in 2020, you sell it in 2030. Without the shield, the entire profit from 2020 to 2030 is subject to the new math. But if you use the shield, you only pay extra tax on the growth that happens after June 30, 2026. This is not automatic. You must proactively opt in. You have to fill out an approved form by the deadline, usually when you lodge your 2026-27 tax return. If you lodge late or forget to tick the box, you lose the protection. Also, it's an all or nothing deal. You can pick and choose assets. The opt-in applies to the whole fund. Interestingly, even if you aren't at 3 million yet, you might want to consider opting in now just in case your fund grows past that limit in the future. We need to get a bit technical for a moment, as this affects the cost of running your fund. Division 296 is technically a tax on you as an individual, not on the fund itself. But the fund is where the money is. So if a fund has multiple members and makes 1.5 million in earnings, how does ATO know which member that money belongs to? For SMSFs, the new rules suggest you may need an actuarial certificate. Usually only funds paying a pension need these, but now even accumulation funds might need an actuary to legally verify how earnings are split between members. For example, between husband and wife with different balances. And what if you lose money? If your fund has a bad year or your expenses are higher than your income, you have a negative earning. The bad news, you don't get a tax refund check from the government. You also can use that loss to reduce your personal income tax outside of super. You simply carry that loss forward to reduce your Division 296 tax in future years. If you are in your 40s or 50s, have a high income, a long history of contributions, or hold a lumpy asset like property inside an SMSF, you are the most likely to be affected by this in the future. Ignoring these rules now could be very expensive mistake a decades from now. So here are some planning considerations. First is asset allocation. It's time to review which assets sit inside super and which sit outside, like in a family trust. The second is contribution strategies. Does it still make sense to maximize contributions if you are nearing the $3 million cap? Third is liquidity. If you have a large property in super, will you have the cash to pay a 30 to 40% tax bill when you eventually sell it? The fourth one is the structure. It's about structuring wealth across time, not just reacting to today's tax bill. Division 296 isn't necessarily about punishing success, but it does fundamentally change the math for Australians who save well. Superannuation is still an incredibly powerful tool for building wealth, but the rules are no longer set and forget. The people who will thrive under these new laws aren't necessarily the ones with most money, they are the ones who are the most prepared. If you found this breakdown helpful, please hit the like button and subscribe for more clear, plain English finance updates. Most importantly, please take this as a prompt to call your financial advisor. The 2027 escape hatch and 2026 shield deadlines are closer than they appear. I'm Vineet. Thank you for watching, and I'll see you in the next video.